A recently announced banking regulation concerning $250 has now been verified by federal officials. If you collect Social Security, a pension, or any governmental benefit, this information may be important for you beginning now. Tim here with USA Daily Alert, and today we are clarifying exactly what this regulation means, who it may impact, and most importantly, what actions you can take to help maintain your funds secure and accessible each month. Stay with me throughout the entire video, because the information in the second half are the ones many individuals miss, and understanding them can help you prevent potential issues. Let us start with the fundamentals. A new federal banking compliance update has been completed, and it focuses around a $250 monitoring threshold that financial institutions across the nation may implement under certain circumstances. Before any worry starts, it is crucial to understand this clearly. This is not a decrease in benefits. It is not a new charge. It is not a restriction on how you use your own funds. Instead, it represents an additional layer of financial protection designed to help safeguard the accounts of everyday Americans, especially seniors, from increasing levels of deception targeting retirement income. Here is why this subject is being discussed right now. Deception schemes have become more sophisticated in how they attempt to target older adults. In many cases, bad actors attempt to take advantage of the timing of benefit deposits, such as when Social Security checks or pension payments arrive in accounts. They may try to act quickly after those deposits occur. In some reported situations, by the time victims notice unusual activity, funds have already been moved. Because of patterns like this, federal regulators have been working to strengthen financial monitoring systems. The $250 monitoring threshold is one of the tools designed to help identify unusual activity before significant harm occurs. So, what does this regulation actually involve? Banks may apply enhanced monitoring procedures to certain transactions that reach or exceed $250 under specific conditions. Think of it less like a barrier and more like a security camera that becomes more attentive when activity appears unusual. Routine transactions such as grocery purchases, utility payments, rent contributions, or insurance payments typically continue just as they normally would. Monitoring systems are generally designed to identify activity that appears different from a customer's normal banking pattern rather than everyday spending. Here is a simple example. If your account has shown consistent monthly activity for years, such as regular deposits coming in and predictable bills being paid at similar times each month, that pattern becomes recognized by the bank system as normal behavior. Now imagine that someone gained unauthorized access to an account shortly after a Social Security deposit and attempted to send several rapid transfers to unfamiliar recipients in amounts around or above $250. Activity that looks unusual compared with the account's normal pattern could prompt additional review. The goal of such monitoring is to pause questionable activity before funds are moved further. A common question people ask is whether this could interrupt daily banking. For most seniors who maintain regular spending patterns, the answer is generally no. Routine bill payments, everyday purchases, and typical withdrawals usually remain unaffected. Monitoring tools are typically designed to identify irregular activity rather than normal transactions. Individuals whose account activity stays consistent are usually the least likely to experience any review at all. Now let us discuss Social Security specifically, since that benefit is often part of this conversation. Retirement benefits, disability payments, SSI and SSDI continue to follow the same federal deposit schedules they have always used. If you normally receive a payment on the second Wednesday of the month, that timing remains unchanged. If your payment arrives on the first of the month, that also remains the same. This regulation does not change benefit amounts, eligibility rules, or deposit schedules. Instead, it focuses on monitoring unusual activity that may occur after funds arrive in a bank account. Similar protections can apply to pension income as well, whether it comes from a private employer retirement plan, a public sector system, or programs such as railroad retirement benefits. Cost of living adjustments determined by federal formulas also continue according to established policies. Any increases tied to inflation or annual policy reviews would still occur as determined by those programs. The $250 monitoring concept operates quietly in the background as a protective measure, rather than a barrier to normal banking activity. It is also helpful to understand why older adults have increasingly been targeted by financial deception in recent years. Reports from consumer protection groups indicate that financial schemes involving adults over age 60 have risen as more banking services move online. Deception attempts may involve phone calls, text messages, emails, or letters that falsely claim to represent government agencies or financial institutions. Some bad actors attempt to create urgency or pressure, encouraging people to move money quickly before they have time to verify the request. In many reported cases, the tactic relies on rushing the victim. Monitoring thresholds can interrupt that sense of urgency by triggering a pause when unusual transfers occur rapidly. Even a short delay can provide time for a customer or bank representative to confirm whether a transaction is legitimate. For someone living on a fixed income, even a few hundred can represent an important part of their monthly budget. So, early detection can make a meaningful difference. Federal officials have described this type of monitoring as part of a broader effort to modernize consumer financial protections in an increasingly digital banking environment. Today's banks process millions of electronic transactions each day. Automated monitoring systems allow those institutions to look for unusual patterns across large numbers of accounts much faster than manual review alone could manage. This leads to an important question. What happens if a legitimate transaction is reviewed? In many cases, the bank may simply contact the account holder to verify the transaction. That notification might arrive as a phone call, a text message alert, or a secure message through an online banking portal. The customer may be asked to confirm their identity and verify that the transaction was authorized. Once confirmation occurs, the review process can often be completed quickly. It is important to remember that such reviews are not accusations. They are precautionary steps designed to confirm that account activity is authorized by the account holder. Responding calmly and verifying the transaction typically resolves the situation quickly. If you ever receive a message that claims to be from your bank and you feel uncertain about it, a safe option is to contact your bank directly using the phone number printed on your debit card or official bank documents. Avoid sharing sensitive personal information in response to unsolicited messages. Now, let us consider seniors who prefer in-person banking rather than online services. For individuals who visit a physical bank branch, day-to-day banking experiences generally remain the same. You speak with a teller, make deposits, withdraw funds, and handle questions just as before. Monitoring systems operate internally within the bank's technology infrastructure. So, customers are usually not required to complete additional paperwork or enrollment simply because monitoring systems exist. For customers who use online banking or mobile apps, these monitoring systems work alongside existing security tools. Features such as two-step verification, deposit notifications, and transaction alerts continue to function as they did previously. Monitoring thresholds simply add another protective layer within the bank's internal security systems. Together, these tools help create a stronger defense against unauthorized activity. There is another situation worth considering. Some bank accounts are shared between spouses or allow access for trusted caregivers or family members. Joint accounts typically show a broader range of transactions because more than one person uses them, but the bank system often recognizes established patterns over time as long as activity remains consistent. Such patterns are usually treated as normal. However, if a new user begins sending unfamiliar transfers to new recipients in rapid succession, that could appear unusual to monitoring systems. If you have recently added someone to your account or significantly changed your banking habits, speaking with a bank representative may help ensure the account history reflects those changes clearly. Family communication can also play an important role. When relatives understand regular expenses and authorized transactions, it creates a clearer record of normal activity. That clarity can help distinguish legitimate transactions from unauthorized ones if questions arise. It also helps protect family members who assist with finances from misunderstandings during any routine review. Consider what this type of monitoring means in practical terms. Many retirees manage their budgets carefully each month, planning for rent, utilities, prescriptions, groceries, and other necessary expenses. In that context, even a few hundred taken without authorization could create serious difficulty. Discovering that kind of loss can be both financially and emotionally stressful. Preventing questionable activity before funds disappear is often far more effective than attempting to recover money afterward. That principle is one reason financial regulators encourage preventive monitoring rather than relying only on investigations after losses occur. Some viewers also wonder whether monitoring rules are connected to possible assistance payments or special government assistance programs. In general, if the federal government authorizes any economic assistance payments, they would be distributed through the same treasury systems that deliver regular benefits. Monitoring procedures do not prevent those deposits from arriving. Instead, they are designed to help protect funds after they reach an individual bank account. In fact, additional deposits could attract attention from bad actors, so having security systems in place may provide added protection. Occasionally, older adults worry that banking regulations are intended to restrict their financial independence. That concern is understandable because many policy discussions have not always focused on seniors' needs. However, monitoring tools described in consumer protection programs are typically intended to identify deception rather than limit legitimate account activity. The purpose is to help detect questionable transactions while allowing customers to continue managing their own money normally. As you watch this information, think about how it may relate to your own situation. Whether you receive one government benefit or several, whether you bank online or in person, and whether your account is individual or shared, the key idea remains the same. Your benefits continue according to existing rules, and financial institutions continue improving tools designed to protect account holders from unauthorized activity. One practical step you may consider after watching this video is reviewing the alert settings provided by your bank. Many institutions allow customers to activate notifications for deposits, withdrawals, or transfers above a certain amount. Receiving those alerts means you can see account activity quickly and identify unfamiliar transactions early. When personal alerts work together with the bank's own monitoring systems, they create a stronger overall layer of protection. Another useful step is making sure your bank has accurate contact information for you. Your phone number, email address, and mailing address should all be current. If a bank ever needs to confirm activity, having correct contact details helps ensure you receive that message promptly. Delayed notifications can sometimes slow verification. So, keeping contact information updated is a simple but important precaution. It may also help to keep a basic list of your regular monthly expenses, including the bills you pay, approximate amounts, and usual payment dates. This does not need to be complicated. Even a small written list can make it easier to recognize unusual activity when reviewing account statements. It can also help clarify things quickly if a bank ever asks you to confirm a transaction. Small organizational habits like this can contribute to long-term financial security. Ultimately, many retirees value stability and peace of mind when managing their finances. After years of working and contributing to programs such as Social Security, people rely on those benefits as a dependable source of income. Financial institutions and regulators continue working to strengthen systems intended to help protect that income from deception and unauthorized access. Monitoring regulations, including thresholds, like the $250 example discussed here, are part of those efforts to improve protection in a digital banking environment. Financial regulations can sometimes sound complicated when described in official language. However, the underlying goal of many security measures is straightforward, helping prevent bad actors from accessing money that does not belong to them. The technology involved may be complex, but the objective remains simple: supporting safer financial systems for consumers. If this video helped clarify how banking security measures work, consider sharing the information with someone who may benefit from understanding it as well. On USA Daily Alert, the goal is to provide clear explanations about financial topics that affect retirees and benefit recipients. Staying informed can help people feel more confident about managing their finances and responding to changes in the banking system. As financial technology continues evolving, additional security measures may appear over time. New tools and policies will likely develop as digital transactions become more common. Even as those systems evolve, core elements of retirement income programs continue operating according to established laws and policies. Social Security benefits continue through the existing system. Pension programs continue according to their plans. Individuals maintain the right to access and manage their own bank accounts. What continues to change is the technology used to monitor accounts for questionable activity. Improved security systems can help strengthen the protection surrounding those funds. Staying aware of financial updates, maintaining consistent banking habits, and keeping communication open with your financial institution are simple ways to support that protection. The key takeaway regarding the $250 monitoring concept is that it represents a security approach rather than a restriction. Its purpose is to help identify unusual transactions and reduce the risk of deception affecting consumers' accounts. Understanding how these systems work can help bring reassurance and confidence when managing retirement finances.